Good afternoon, everybody, and welcome back to the weekly Fintech Nexus news show. My name is Peter Renton, Chairman and co-founder of Fintech Nexus. I'm coming at you from Austin, Texas today, where I'm here at the Consensus Show, the crypto show here. Todd is has just been to Money 2020, so the Lend It team is on the road. How are you doing, Todd?
I'm good, Peter. How are you?
Doing great. And our special guest
now in London, by the way.
You're now in London. That's right. Moved on from Amsterdam. And for the first time, we have Nick Bolanovich. How are you doing, Nick?
Good. I'm just in the middle ground for you two over here in New York.
Right.
First, but hopefully not the last time.
Why don't you give a quick 30-second intro about yourself so the listeners know who you are?
Let me see if I can get it to 30 seconds. But Peter, thank you for having me on the show. Todd, it's great to see you again, too. Been working in the fintech space for a little over a decade now. Was the first hire over at Funding Circle with Sam and Alex in San Francisco. And then joined the early team at Pedal, building a credit card using cash flow data to get their first product to market. And spent the last 2 years at Google Pay in the US heading up business development before leaving at the beginning of this year to switch to the investing side, where I started a small early stage fintech investment fund, very, very creatively called the Fintech Fund. And that's most of my time these days. But outside of that, run a fintech community and newsletter called This Week in Fintech. And Peter, knowing you, and you've definitely been an inspiration with everything that you've built at Fintech Nexus. So excited to be on the show.
Great to have you. And yes, we go back a long way. I remember when we used to meet in the office in San Francisco in Funding Circle back in the day. That was like 8 or 9 years ago. But anyway, we have a busy news show, just like usual. But this first thing we need to talk about, which I think has been the biggest story in some time, and it's all about Apple. They had their Worldwide Developers Conference. They announced the upcoming features of iOS 16. And the one feature that has grabbed everyone's attention in fintech is that Apple Pay is going to have a buy now, pay later offering. Basically, Apple Pay Later. It's just it looks like a clone of Afterpay, just pay in four installments. It's going to be available for any user of Apple Pay, and it's big news. I mean, this is something I've said for a long time that I think the most underdeveloped app in all of fintech is the Apple Wallet. It just doesn't do much, and it should do more. And here is an example of them doing a little bit more. Thoughts?
I mean, we all wondered the acquisition of Credit Kudos, what that meant for Apple and what were they doing there. I think the most surprising thing about the announcement was that they're taking underwriting in-house.
Yes.
So I think that was, that was kind of the shocker of the announcement. We just assumed that they'd probably just, be working with Goldman in a similar way that they did the Apple Card. But that was an interesting thing. The other thing I think is probably the larger story is, and I've said this for a while, is the creation of this Apple ecosystem. Apple TV, Apple Wallet, now Apple Pay in 4 or whatever they're going to call it. I mean, they're creating something where you essentially go in your phone and don't have to leave, or go on your computer or your iPad and don't have to leave. And it's an interesting play. I think Square or Block is doing similar things, and Stripe. It's kind of like these little ecosystems that are creating, within the larger ecosystem. And so, I think the larger play is going to be something to watch, but this is something that if I was a buy now pay later company, I'd be pretty scared, especially if I wasn't like Affirm or Afterpay and some of the big ones, because this is big news that's going to eat right into what they're trying to do.
Yeah, I mean, I'm always a little bit reticent to give too much credibility to people who say, Apple or Google is going to decimate this industry. Because there are a lot of product forays into industries like fintech that don't necessarily end up, taking away too much market share for the incumbent. Google Pay was supposed to kill, PayPal and Venmo, I think, for the last 10 years, but Cash App ended up kind of taking away that market share, and with Google Pay, it hasn't happened yet in the US. But I do think it is kind of a warning signal in mass consumer buy now, pay later that just like credit cards, buy now, pay later is not necessarily a product with any real moats developed in it. You are effectively selling a commoditized product, and you have to find good ways to differentiate it and to find your niche or your specialty that allow you to win over consumers that are not going to work with multiple different providers. And I think it also shows that differentiated underwriting is not a long-term viable moat either for a buy now pay later product. Balance sheet is the real moat. Can you amass capital at such a low rate that you're able to effectively split these installments into customers at 0% interest? Like that seems to be like the compelling differentiator here. But as far as I can tell, that's the only obstacle to launching a new product in this space. So I think it is a cautionary tale, especially for the smaller buy now pay later providers that are generalists and haven't yet scaled up yet. You need to find a differentiated niche. With Apple, Todd, I could not agree more with you. I think it's unlikely that Apple wants to become a financial services company here. I think what they're trying to do is create more lock-in to their own product ecosystem and more benefits of staying within that ecosystem. And so if you have the Apple Card, if you have access to Apple's buy now pay later feature, or if you're on the path to Apple Card, which is like their credit graduation program into Apple Card, or if you use their prepaid card product, which is now Apple Pay because they've included a digital wallet with it with peer-to-peer payment functionality. All of these products can be built into paying for things on your iPhone, whether it's in the App Store, whether it's surfing Safari. It just makes your experience that much better in the ecosystem if, like you said, you don't have to leave it to grab your credit card or connect an external form of financing. So I think Apple will sell more products themselves, and they're looking to continue growing their GMV over time, as they saturate their market. And if they can take a percent of those transactions as they're growing or as others are selling their products through iPhones, it's kind of a no-brainer for them. But outside of creating that kind of like ecosystem value, I kind of doubt that they're trying to become a banking product.
Yeah, and I've read some things of people saying they're going to get 50% market share. Someone even said 80% market share. I mean, I feel like that may be a little optimistic. Certainly,
I think it's just more the like you said, Nick, it's the earlier BNPL who haven't really reached scale yet, who will probably be hurt by this.
But it's like credit cards, though. I think credit cards are a good industry comp here. And you have this extremely fragmented credit card market where, like, launching the Apple Card, it's a vertical specific card for a certain type of person, but it's not really going to threaten other card issuers. Distribution.
And it's not going to kill credit cards either. BNPL.
No,
it's just another credit product.
Yeah, that's a story for another day. But there's, as you say, it's like there's room for many players. That's what Max Levchin said this week. The market is large. It's getting larger every day, and there's room for multiple players. We could spend the whole 30 minutes talking about Apple, but we're not going to. Moving on, PayPal. This is a long-awaited feature that they have finally launched. They're basically allowing users now, you can send and receive crypto to and from outside wallets from your PayPal crypto wallet now. And they're encouraging users to sort of consolidate their crypto at PayPal. It's only available in the US right now, but I imagine they'll be rolling it out globally. And interesting thing that I read about this piece was that this is made possible from their BIT license they have through the New York Department of Financial Services. And that, I feel like PayPal has, they've been playing around with crypto for a little bit. They continue to make more and more moves in this space.
Yeah, and I think the larger story about bringing in the other crypto is more interesting. And to me, the space in general, the interoperability, cross-chain is, to me, the more interesting story is how do all these things begin to play with one another, and do they play with one another in a way that's, efficient and not, doesn't get killed on fees and whatnot when it comes to, the interoperability and cross-chain. I think it's a natural move, and obviously a move they already talked about. I think it was a year ago or whatnot, but the larger piece of how will the different players start to work together, and what that means still remains to be seen, for the wider market, but a move that we kind of expected.
Mm-hmm.
Yeah, I agree. I think it's a really interesting play on PayPal's part. And you've seen longtime Robinhood users also who are crypto purists give them a very hard time for having a custodial wallet and not allowing access and ownership to the crypto that they're purchasing through the Robinhood marketplace. And so Robinhood's doing this as well. And the bet that you're kind of making there is that if you're building any kind of stored value platform, like a digital wallet or like an investment platform that is ranked by AUM, do you benefit yourself more by building a walled garden or by creating interoperability? Well, you can see the obvious allure of a walled garden. If you have an easy way for customers to amass assets on your platform without being able to move them off, then obviously that's long-term better for your business as a whole, because you're trying to grow your AUM or you're trying to grow your stored value balances. But I think PayPal's making an interesting bet here by saying interoperability is actually going to be net beneficial to us in the long term, not just because you have like the hardcore crypto purists who want to be able to move money back and forth between wallets, but then if you have kind of seamless connectivity across different wallets, whether they're self-custodial, whether they're managed by third parties, it becomes less about where the money can move and flow and what the benefits are of holding the money in different places at rest. And so PayPal starts competing on what you can do with your money when it's held as crypto in your PayPal wallet. So all of a sudden, if they're offering features on top of it, like easily pay with crypto at any merchant online, or get honey discounts at a merchant and pay through crypto or a stable coin, or earn interest on your holdings that are sitting in your PayPal balance, and they're doing the back-end lending, then it becomes a really accretive move for them because they start inbounding a lot of crypto stored in other wallets because they have a better offering for what happens to the money at rest.
Good points, Nick. Okay, let's move on. This has been the talk of the Consensus conference today. The new Responsible Financial Innovation Act. It's a bipartisan bill that has been put forward by Senator Lummis and Senator Gillibrand from Wyoming and New York, respectively. This is what we've been waiting for in many ways. The federal regulation of digital assets. Basically, they're saying that the CFTC should be the agency that actually regulates them. They're calling most digital assets commodities, and they have the head of the CFTC speaking here earlier today, who is welcoming this move. We've introduced a new term called ancillary assets, which is what they're going to call digital assets or crypto assets. So it's a big move. I mean, basically the view here is that this is a opening salvo, and the final bill will look nothing like this, nothing like what's on here, but it's good. It's mostly supportive of what the crypto community is saying here.
I think the scarier part in the piece that I read was, the thought that they could break the bill up into smaller bills, which would probably turn it into a complete mess, like Congress and those in the Senate and the House usually do. Overall, I mean, reading on the face of it, it's something that I think the crypto industry would wholeheartedly embrace. I don't know how Democrats on the Hill will actually embrace it, because they've been harsher on the industry as a whole. I think reading through what I've seen, it seems sensible and reasonable. It's not over the top. It seems like they've done their homework, and it's kind of like a middle path that makes sense for a lot of the pieces in the ecosystem.
Yeah, I feel like DC is being pretty reasonable with their approach here, and I agree with both of you that the long term is probably not going to look anything like this bill. Right now I feel like we're treating crypto a little bit as a monolith, and there are currencies that act like securities, and there are currencies that act like commodities, or act like currencies, and it's in all likelihood there's a different regulatory regime that's going to be applicable for each of them. So I think there's a lot of territorialism over which financial regulator in the U.S. is going to ultimately regulate crypto, and my bet is that it's all of them. I think every state and every financial federal regulator is eventually going to regulate crypto. It's just a matter of understanding better the different use cases and the different ways that people use it. Well, I guess that's two ways of saying the same thing. But this just feels like an opening salvo and not at all kind of a long-term, steady state for crypto regulation. And it's funny, the hardcore libertarians in the crypto world will probably be mad about this, but for the most part, this is a really positive indicator for the space. If it's big enough to get regulated, that means it'll be around.
Yeah, it's like the general theme here today in Austin is that this is only positive. There's really a good, this is much better than having nothing, and it's a good starting point. That's what most people.
Well, they needed to put something down, and it's a good start, but they needed to start. They've been talking and talking and talking. The Biden, order was pretty bland and kind of spreading it out to the agencies and whatnot. Putting something down on paper is a real big first step.
Right. And let's staying with crypto and the federal government. Caitlin Long, who spoke at Fintech Nexus just a couple of weeks ago, was also speaking here today, and she made news by her bank custodia is suing the Federal Reserve, and she wouldn't talk about it obviously on stage, but it's pretty clear that she's been frustrated. She was told it was going to take a week to get a master account decision. It's been 19 months, and 12 months apparently is a statutory deadline. So she said the Fed have gone 7 months past their own deadline, and they haven't told her why. And that's where I think it's just so criminal what the government does sometimes. By you don't have any idea how or why. It's just you just get told, and you're in the dark. So I mean, she's not going to win any friends in the federal government by doing this, but I think she's trying to make a point that this is unacceptable.
Let's just hope she gets a friendly judge that kind of at least not necessarily takes her side, but gives her the time to review the case and doesn't say like, oh, the Fed had reason to delay. Ultimately, it's about transparency. If they're going to delay, then just tell her this is why we need to delay, and we'll continue to keep you in the loop. But the government
still says she has no idea. Like she says, literally, she has no idea why it's being delayed.
That's just asinine.
Yeah, I admire the chutzpah of taking the Fed to court. Although I'm not bullish on their chances. It would be nice if this resulted in clearer guidance for other custodians about how to move through the licensing process. But I don't know. I'm a little skeptical that it will.
Yeah, I mean, that's the thing. I mean, the best case scenario is this sort of, doesn't actually go to trial or anything. It just it gets settled.
Probably issue some bland statement that the Fed has some power that we're all unaware of to delay or something. I don't know.
Yeah. Okay. Moving on. More news this week. Our good friends at Fireblocks have partnered with Checkout.com to settle payments now in USDC. And what this is going to really mean is that Checkout.com, that has obviously it's checkout system that used by I think millions of merchants, certainly many merchants. This is going to allow them to settle 24/7, and settle instantly. So you get small businesses that are using Checkout.com will be able to get their money in real time in 7 days a week. That to me is the big news. They've already done $300 million in transactions in their beta tests. So I think this is a really important.
Quite the beta test.
Yes.
300 million. But I mean, it's this type of solution is what, and I actually talked to Jess at Money 2020. But this type of solution is exactly what merchants want. Is they want real-time access to capital, and if it's a certain time of day or the weekend, it feels as if it's not possible in today's world. And then you get a partnership like this, and all of a sudden it unlocks a lot more. And so this is arguably the perfect example that you want to see of kind of fintech Web3 merging together. And it's welcome news, and curious to see how it turns out for them. But checkout.com is obviously making some moves here.
I agree. I love this partnership. And coming 2 or 3 weeks after the Terra Luna blow up, it's pretty interesting timing, because you can see that not all stable coins are created equal. USDC is backed 1-to-1 by dollars, which I think is something that gets checkout.com comfortable with this as a payment method. It'll be interesting to see long term what the regulatory treatment of this is. In the US, this is effectively what RTP and the Fed Reserve's FedNow systems are trying to create, is this real-time settlement and transfer system. And so the question in the long term is, are they comfortable with a privately owned, held, backed, and managed stablecoin facilitating effectively the same interaction? Or, and I know, Checkout being a UK company, the question is does the Bank of England decide that they're comfortable with private stable coins, or that it needs to be a central bank issued one?
Yeah, that is the big question. There was actually a debate on that at a really good session here today on that very topic. And it was really, there was one side was taking that it has to be the federal government to be issuing these things. The other side was taking, if we wait for the federal government, it's going to take another 5 years. Meanwhile,
it could be both.
Yeah, it could end up. But long term, I think there could well be. But
and that goes back to interoperability. How does the CBDC network work with a private network like this?
Right. Okay, moving on to Upstart in the news this week. I remember I wrote about this back in 2017 when it came out. They got a no action letter from the CFPB on their AI-powered underwriting model, and they have it's come to a mutual decision to terminate that no action letter. And Upstart wanted to update the models with the new variables. CFPB didn't really like the new CFPB guy. Doesn't even like the no action letter program. Period. He felt like that the no action letter could have, was a tacit endorsement of from the CFPB, and that's not what he wanted. So anyway, Upstart no longer has the CFPB's no action letter as part of their arsenal when talking with other regulators and really talking with their investors. But clearly, I think it's they decided it wasn't worth it anymore.
I don't know. This is like the no action letter was 3 or 4 CFPBs ago. That was the Rich Cordray CFPB with Dan Kwan and Project Catalyst and the Office of Innovation. And, that organization's changed a lot. And it just doesn't seem like no action letters have a lot of market value for startups. I guess that's my takeaway here, is effectively, the CFPB will publish proposed rulemakings, and it will take action against companies that are in violation of the standards that it upholds, whether it's UDAP or whether it's any other part of the Truth in Lending Act or other Dodd-Frank laws that it's going after startups for. And I think that if you're building a product like Upstart is with alternative underwriting, and for whatever reason it's found to be in breach of a regulation the CFPB wants to enforce, you'll probably have a notice period from them. They'll probably reach out. I think that is a pretty reasonable organization that's going to give you a lot of heads up and give you a window of time to change your practices instead of just coming after you with an enforcement action. And so the question is does a no action letter really do anything on top of that? And it feels like the verdict is kind of no in this case.
Yeah, I mean, I've always wondered about it myself. I mean, we've had Dan Kwan on many times, and he was the father of this no action letter in many ways, and he was a huge supporter of it. But
I think they got some juice out of it because it was the first. Yeah. But after that kind of little bump,
nothing much happened.
It felt like it just kind of faded. It was like, oh, this is the first, and then it was like, all right, that ended.
Yeah, like your old employer Petal never tried to get one, right?
Yeah. But we thought it was really interesting when it came out. We're kind of curious to see whether that would open the floodgates for more no action letters to get signed.
Yeah, didn't. Okay. Anyway, let's move on. This was an article really about the Money 2020 event on CNBC. They were just talking about the mood is grim, is very grim, was actually the headline. The once hot fintech sector faces IPO delays and consolidation. The Stripe not CEO, the other Collison, the president and co-founder, he says Stripe may not be worth $95 billion today. And so that's a pretty, that's not exactly surprising. That's surprising, I would say, in public, but everyone knows that. Zopa was going to do an IPO this year. They're not going to. Various CEOs saying it's difficult raising money. I know I had Matt Harris talking about this on the Fintech Nexus stage a couple of weeks ago. He thinks that you've got a window till the end of June, and then you will not be able to raise money from outside investors. It has to be an inside round if you want to raise money. So it's looking grim. What did you find at the show, Todd?
There was a lot of valuation talk. People are there is a worry in the market, but at the same time, there's also the cream will rise to the top. Like, this is where the best companies, the best executives, the best teams figure out ways to navigate. Maybe they, tighten a bit and don't raise that outsized round. But there's also going to be a lot of opportunities to acquire either teams or acquihire, potential technologies. So there's going to be consolidation, and I think you'll find that there's a lot of opportunity out there. But yeah, there's definitely headwinds, and people are concerned. The question is, how long does it last? I don't think any of us know.
No, that's the $1 trillion question right there. If anybody knows, please let me know. But Peter, to that comment, is Stripe worth $95 billion today? I feel like the most important word in that sentence is today. Right. What we're seeing is a normal correction in the course of the business cycle. People have been talking about overinflated asset valuations, at least since like Lloyd Blankfein at Goldman brought it out in 2017. And so they're not, they're ramping down equity exposure because they thought that the market price to earnings ratios were unsustainable at that level. And that was 5 years ago. People said the same thing at the beginning of the pandemic, where we had the kind of V-shaped recovery. And I don't think that that's going to happen again now, because we're absent, a very ambitious, system of state subsidies and money printing. But, whether it's 6 months or 12 months or 18 months, I agree with you, Todd. I think this is a period where there will be a recovery, and well-operated companies will make it out and hit escape velocity. And companies that had been really dependent on, an era of cheap money and easy liquidity are going to find themselves, kind of falling back on their resourcefulness now. And I think that there's really a lot of silver linings to founders. And I have had conversations with our LPs about this. Marketing budgets are going to go down. And so if you're trying to compete to acquire consumers for your fintech product, you'll have more reasonable CACs, and you'll be able to acquire consumers at a lower price point. Similarly, salaries have been inflated over the last couple of years with the kind of heyday of fintech fundraisers that we've seen. In all likelihood, salaries and equity requirements will condense a little bit. And as some of these companies consolidate or wrap up or wind down, more talent's going to enter the market, and this talent will have fintech training. So I think if you're an early stage founder right now, there's actually a lot to look forward to in terms of being able to acquire really good talent and go out there and build your company without a lot of the noise that came from the increased competition that easy funding facilitated over the past few years.
So, are the CEOs that you're talking to, Nick, are they still pretty optimistic about their early stage? Most of the ones you chat with, are they optimistic about what's coming down?
I'm looking at a very specific market segment, which is pre-seed and seed. And so for the most part, I think there's some anxiety about, will you hit a bottleneck at the Series A? Are the milestones going to be impossibly high, 12 months from now for us to go out and get a significant level of appreciation on our equity? And the way I tell people to look at it is think of the analogy of deep space exploration. If you're sending a mission to Mars, it doesn't really matter what the weather on Mars is like today because it's not going to arrive for 6 months. You need to be a little bit more focused on what the arrival point looks like, when you're closer in time to the arrival. And so similarly here, if you're just raising your first, funding, whether it's friends and family or outside funding for a company, you shouldn't really be thinking about what the exit landscape looks like today. You should have a rough idea of, what the possible exit scenarios are for you. But your, average horizon to exit is going to be somewhere in 5 to 10 years. And so as long as you're building a great product, valuations today aren't going to be as directly relevant to what your, ultimate exit scenarios look like.
Right. Okay, well, we are out of time. We'll have to leave it there. Thank you very much for coming on, Nick. Thank you, Todd, as always. And of course, thank you to everybody.
Thanks, Nick.
Thanks for having me.
Watching. And we'll be back same time next week. Have a great weekend, everybody. Bye.